Yes, so the question reads, 𝗏 Limited operates in fast-moving goods subsector during the year which ended 31st of October, 31st March 2023. 𝗏 Limited expanded its operation by acquiring controlling interest in 𝐶𝐈 and a significant influence over the activities of 𝗂𝗂 Limited. The following draft financial statement for the year which ended 31st of March 2023 relate to the three companies. So we are given the statement of profit or loss for the year which ended 31st of March 2023 for 𝗏 Limited, 𝐶𝐈, and 𝗂𝗂. We have revenue, cost of sales, gross profit, distribution, admin, profit from operation, investment income, finance cost, profit before tax, income tax expense, and then we have the profit for the year. Then we have the statement of financial position as at 31st of March 2023 for 𝗏, 𝐶𝐈, and 𝗂𝗂 there, where we have non-current assets, which include property, plant, and equipment investment. And then we have the current asset, which include inventory, trade receivables, financial asset at fair value through profit and loss, cash and bank balance. We have the total current assets. And then we have equity, which comprises of ordinary share capital, share premium, retained earnings, and then non-current liabilities, which include 12.5% raw notes, deferred tax, and then we have the current liabilities, which are trade payables, current tax. Then we have some additional information, number 1 up to note number 8. Maybe you're going to go through that. And then what are we required to do in our case is to prepare the consolidated statement of profit or loss as at 31st of March 2023, and Part B, consolidated statement of financial position as at 31st of March 2023. So anytime you come across a question for group accounts, so the first thing you need to do is to develop, or in other terms, you need to come up with a group structure. So group structure is basically a form of a diagram which will be showing the parent company shareholding in the other companies, because there you can see we have 3 companies. And actually, I hope you can remember in paragraph 1, we were told that this company, which is called 𝗏, has decided to do what? To expand by acquiring controlling interest in S and also significant influence in activities of what? 𝗂𝗂. We need to come up with a group structure which shows the parent company shareholding in the other 2 companies, so that now we know the nature of investment by the parent company in the other companies. We know whether 𝐶𝐈 is a subsidiary, whether it is an associate, and so on. Yes, so where do we get the information about the group structure? We get that information in the additional information. So therefore, this is the first thing always you need to come up with the question for group account. In additional information, number 1, you are told on 1st July 2022, 𝗏 Limited, we are told that this company acquired 80% ordinary shareholding in the company which is called 𝐶𝐈 Limited. On which date? On 1st July 2022. So those are the details you need to have to capture here. The shareholding by this company in this, and also the date of acquisition. The date is very important. So, and therefore, from this information which we have here, 𝗏 will be the parent, whereas 𝐶𝐈 is a subsidiary, because you have said once an investor company, the parent company acquires shares, which lies between 51% to 100%. So then that company will be a subsidiary. This is a subsidiary. So then from there is also some information you're given in note number 3. We have first of all skip to note number 3. Note number 3. In note number 3, what are we told? We are told on 1st of January 2023, 𝗏 Limited acquired 40% ordinary shareholding in the company which is called what? 𝗂𝗂. So this company here also acquired 40% shareholding of the company which is called 𝗂𝗂 Limited on 1st of January 2023. So this company therefore is what? Is an associate, because you have said if the parent company acquires shares which lies between 20% to 49% of the investee company, the investee company therefore is an associate. So therefore, 𝗂𝗂 here is an associate. So that is basically our group structure here. Our group structure. So this is the parent, this is a subsidiary, this is what? The associate. And therefore, if you check on the requirements there, what are we required to do? We are required to prepare the consolidated financial statement. Specifically, we are required to prepare the consolidated statement of profit or loss and the consolidated statement of financial position. Number one, in preparing the consolidated statement of profit or loss, you have to recall very fast what you have said. We need to combine, we add together similar items of revenue and expenses, those of the parents, those of the subsidiary. Do we include the revenue and expenses of the associate in the consolidated statement of profit or loss? No. We have said as far as this company is concerned, what we include in the consolidated statement of profit or loss is the parent company share of associate profit after tax. We don't combine the revenue and expenses of the parent with that of the associate. The same case, in preparing consolidated statement of financial position as required in Part B, we are only going to add assets and liabilities, those of the parents, those of the associate. Do we include the assets and liabilities of the associate in the consolidated SOFP statement of financial position? No. So what we recognize in the consolidated statement of financial position as far as the associate is concerned is something we have referred to as the investment in associate. Investment in associate. Sasa, that is what we need to remember very fast. But equally, on the other hand, when preparing this consolidated income statement, where we are saying we are going to add revenue and expenses of the parent and that of the associate, you have to check when this, not associate, sorry, the revenue and expenses of the parent and that of the subsidiary, you have to check when this subsidiary was acquired. Because if it was acquired during the current year, then you include the revenue and expenses of the subsidiary from the date it was acquired. You prorate that on time basis. So you can see 𝗙 was acquired on 1st July 2022. So who can tell us when are we required to prepare the consolidated statement of profit or loss? from the requirements. In our requirement, when are we required to prepare the consolidated statement of profit or loss? Give me that date there. Give me the date. When are we required to prepare the consolidated statement of profit or loss? Yes. When is the date? When is the date? When is the date? When is the date? Someone is not having the question we are doing. So yes, the date is the 31st of March 2023. 31st of March 2023. So basically what that means is that this year here, when the date started, if the year of a company or the year of the group is ending on 31st of March 2023, when did that year started? When did that year started? When did that year started? When did the year started? So if the year is ending on March, 31st of March 2023, that year started on which date? The year started on which date? I'm only getting the answer from one person. You should know the date when the year started. Very fast there. This year started 1st of April, because if the year is ending March, the next year will start 1st of April. This year started 1st of April 2022. You can see, therefore, our subsidiary company was acquired during the current year. This subsidiary, because it was acquired 1st July 2022. So how many months do we have here? From the date our subsidiary was acquired, which refer to the date of acquisition, to the date we are required to prepare the consolidated financial statement. That date we refer to it as the date of consolidation. How many months do we have here? 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 That is a very simple question. I'm not getting the answers from you. So give me the answers here so that we move. So I think I've already reshared the question in the class WhatsApp group. I've reshared the past papers because the past papers were shared some time back. I've reshared them in the class WhatsApp group. I've reshared them in the class WhatsApp group. I think our friends from Rwanda, can you check that in the class WhatsApp group? Check that in the class WhatsApp group. I've reshared those questions there. Yes, so here we have 9 months. We have 9 months here. So we have 9 months. What does that mean? It basically means that in preparing this consolidated income statement, we are going to take the revenue and expenses of the parent for the revenue and expenses of the parent for the whole year. But for this one, that is 𝐶𝐈, which is a subsidiary, we are going to take into account the revenue and expenses for how many months? For how many months? 9 months. And basically we combine that with that of the parent. And therefore, if you come across such a question in an exam setup, how should you approach it? Because you have to do this question within how many minutes? How many minutes do you have to tackle on each of these questions? You have 3 hours, meaning that you have 180 minutes where you need to do 5 questions. So basically it means that for each question, you should not take more than 36 minutes. 180 divided by 5, you have less than 36 minutes. So basically how you handle this particular question, you always have a sketch of what you're required to prepare. And I think that is the approach I will show you. So you come here, never start with the workings. The first thing you should have is the group structure. This is the one which guides you to how to prepare the group account. So once you have this, then go straight to the requirement. Have a sketch of what you're required to prepare. And then later on, you are going to go through the additional information as you make the necessary consolidation, and adjustments. So therefore, can you go straight to part A? To part A. In part A, we are required to prepare the consolidated statement of profit and loss, which is for the year which ended 31st of March 2023. 31st of March 2023. So we always prepare this from the individual or from the statement of profit or loss prepared by individual company. So which is now at the paragraph 1. That is what we use to prepare this. We need to have a single column here, and our figures are given in millions, of shillings. So what we start with, and I hope those who didn't have the question, you have gotten that question in the class WhatsApp group. Have you gotten the question? Have you gotten the question? Those who are requesting the question to be shared with you. 𝗙𝗏𝐻, who else is here was requesting for that question here? Yes, I hope you have gotten those the question. I've reshared and Clement. No, I've already shared that question in the class WhatsApp group. Zainab, are you part of the class WhatsApp group? Zainab, are you in the class WhatsApp group? Zainab. Yes, if you are there, I think I've reshared the past papers. I've reshared the past papers there. I've reshared the past papers there. Have you seen it now? Have you seen it? Have you seen it? Okay, so let's just move. Zainab, what is happening? The question, I've already shared the question in the class WhatsApp group. You should see it there. If you are part of the class WhatsApp group, you should see it there. Okay, so let's move. So in this case, I'm saying we combine revenue and expenses of the parent with that of the subsidiary. And then for the items of revenue and expenses for this company, that is 𝐶𝐈, we have said we are going to take them for 9 months. So that's basically what we need to do. So we're going to take the revenue of the parent. Parent is 𝗏, which is 4190, plus that of 𝐶𝐈. For 𝐶𝐈 is 2600, But now, because this one was acquired 9 months to the end of the year, what we do, we multiply this with 9 all over 12. Our subsidiary was acquired 9 months to the end of the year. You are not taking the revenue for 𝐶𝑖 for the whole year. You take the revenue for this from the date it was acquired. You multiply that with 9 all over 12. And then in this case, and it's very important to note that this 9 all over 12 only apply to this. Never make a mistake of multiplying this or prorrating this on time basis. We take the revenue for the parent for the whole year. So this 9 all over 12 is only applying to that. Then what we do, cross the bracket here. Or basically don't cross the bracket because we need to go through the addition information. The only adjustment which is made to this is that we less any sales. If there are sales between parent and the subsidiary, we less it here, what we refer as intra-group trading. So then from there, we take the cost of sales. And I hope you can see I've not taken the revenue and expenses of 𝐶𝑖. We don't include the revenue and expenses of the associate here. So the cost of sales, we do the same. We have 2730 plus that of 𝐶𝑖, which is 14. But this one we multiply it with 9 all over 12. Equally, we cross the bracket. The number of adjustments which we make to the cost of sales. Then we will get the gross profit. Then to that we less before raising the distribution. Before raising the distribution, there is something we need to add to this gross profit. We need to add the parent company share over associate profit after tax. So our associate is 22. So what we do, can you go to the income statement? You tell me how much was the profit for the year for 22? The profit for the year for 22, how much was it? From the income statement of 22 at the paragraph 1. How much is that? How much is that? That is a figure of what? Of 200. That is a figure of 200. I need to get the answers from each of you. Otherwise, if you don't give me the answers, I will not know whether we are together or not. Once you get the answer, type it in the chat box. I'll be able to see it. I'll be able to see the answer. You participate by giving Marimu the answers. Type the answer there in the chat box. I'll be able to get it. I'll be able to see it. I'll be able to see it. So that is a profit for the year reported by what? By this company. But if you check on the date, our subsidiary was, not subsidiary, rather, the associate was acquired. It was acquired on 1st January 2023. And actually, that is some few months to the end of the year because the year ended on 31st of March. So basically, it means that this associate was acquired 3 months to the end of the year because we have January, February, and March. The year came to an end. So meaning that the parent company will not be entitled to share the profit for the whole year. The parent company is only entitled to share profit for how many months? 3. From the date it acquired that associate. That's why we need to compute the profit for 3 months. And then we get the parent company share of that. The parent company share of that will be equal to 40%. 40%. The parent company shareholding here. And usually these do not have any adjustment. You just go ahead and you get the final figure. So this will be a quarter, which is 50, 20%, 40% of that, 40% of 50. That should give us what? That should give us 20. That is now what you include there. And then from there, we proceed, we less now the expenses. The expenses include the distribution cost. For the expenses, we are only adding the expenses of the parent with those of the associate. We don't include the expenses of the associate here. So the distribution we take for the parent 300. And then for the associate, we take 200. But this one, we are only taking expenses for 3 months. For 3 what? For 3 months. And then the other thing you also need to note here is that any question for group account, this item here do not have any consolidation adjustments. So always these are free marks. Anytime you come across a question for group account, usually these distribution costs do not have any adjustment. So you just add the distribution of the parents with that of the subsidiary. In fact, this one, we can just get the final figure because even in the addition information, no single time will be told a distribution cost is to be adjusted. So these always do not have any adjustment. So this will be 300 plus 3/4 of this. 3/4 must be 150. And that should be 450. That should be 450. Someone to confirm whether that is 450. Is that 450? Yes or no? Is it 450? Is it 450? 450, yes or no? Yes, it is 450. It is 450. So then below that, what do we have? We have the administrative expenses. The administrative expenses. The administrative expenses, we take that of the parent, which is the 500, plus that of the subsidiary. That of the subsidiary is 400 times 9/12. And then we leave the bracket open here. Mostly, this is adjusted with impairment loss. In what we know is that once the parent company has acquired a subsidiary, usually there is goodwill on acquisition. So you may be told that that goodwill was impaired with a certain amount during the current year. So that impairment loss, we include it as part of the administrative expense. And then from there, we will get what? We will get the profit from operation. The profit from operation. Remember, we are saying that this is the approach you should use in an exam setup, because you don't have all the time to do this question. This question, you have to finish it within how many minutes? Within 40 minutes, you must be done and go to the other question. We will get that. And then below the profit from operation, I'm using the format which you're given at the paragraph 1. There is nothing we are changing. Below that, we have something called the investment income. So for the investment income, we take that of the parent, which is 40, plus that of the subsidiary, which is 20. But for that subsidiary equally, we are not taking for the whole year. We multiply that with the 9/12. 9/12. And then we leave the bracket open. We will come back to that as we check whether there is any consolidation adjustment. So the same case with the finance cost. Finance cost, we take that of the parent, 80, plus that of the subsidiary, 60, times 9/12. Equally, we leave the bracket open, and then here we will get the profit before tax. The profit before tax. And then to this, what do we less? The income tax expense. So the income tax expense, these also always a free mark in any question for group account. These do not have any adjustment, just like distribution. So this one, you just add that of the parent, which is 180, plus that of the subsidiary, which is 160. But for the subsidiary, you multiply that with 9/12. This one, you cross the bracket, because I'm saying just like distribution or single question for group account, you'll be told these two items are to be adjusted. Sasa, yes, we get the final figure for this one. This 3/4, which is the which is the 120 plus this one, that should give us 300. And then we get the profit for the year. We will get the profit for the year. And also, what is important for you to note as you do this particular question for group account, for any correct entry which you have here, always you get 2 marks. Any correct entry. And what is marked are these entries. You see, these are the entries which are marked. So any correct entry which you have here, any correct figure you have there, how many marks? 2. And like in that case, take into account the marks allocated were 8 marks. It basically means that for you to get these 8 marks, you need to get 4 items, 4 correct figures here. For any correct figure, many marks will you get for each? 2. So meaning that, like in our question here, even if we leave it at that point, we already have 6 marks out of 8. We already have how many marks? 6, because you can see we have 3 correct entries. This one, distribution, I've said this never have any adjustment in any question for group account, and the income tax. And the income what? Tax. Even if we leave it at that point, we already have how many marks? 6. So then, even before you go to the additional information, the other thing you need to do is basically now to have a sketch of the statement of financial position. This is now what you refer as a sketch, because there are some figures, final figures, we need to come and get down here as we go through the additional information. So let's do that. Part C. This should be part B. Consolidated statement of financial position as at 31st of March 2023. 31st of March 2023. 2023. So we equally need to have a single column here, and the figures are in what? Are in million of shillings. So now what do you need to remember here is how do we prepare this one? We prepare the consolidated statement of financial position by doing what? Combining similar items of assets and liabilities, only those of the parent and those of the subsidiary. Only those of the parent, those of the subsidiary. We don't combine assets and liabilities of the parent and those of the associate. So what do we include here? As far as the associate company is concerned, as far as 𝗏𝗏 is concerned, we compute something called investment in associate, and we recognize it here as an item of non-current what? Asset. That's what you just need to remember. So therefore, what you're going to start with here are the non-current assets. And actually, we prepare these using the statement of financial position prepared by individual companies. Individual companies are 𝗙𝗏, 𝗓𝐸, and 𝗏𝗏. We have that just below the statement of profit or loss. So the first item which you're given here is the item of PPE. So property, plant, and equipment. So we are adding the PPE of the parent, which is 2070, plus that of the subsidiary, which is 1290. The other thing which is also very important here to know, because that is another mistake I've seen majority of the students doing in the past. Number one, when taking the assets and liabilities of the subsidiary, like which is 𝗓𝐸, I've seen in the past student multiplying the assets and liabilities of the subsidiary with 80%. That is very long. So even if the parent company do not have 100% shareholding in the subsidiary, you take the full amount of assets and liabilities of the subsidiary, you combine that with those of the parent. Never multiply the assets and liabilities of the subsidiary with the parent company shareholding in what? The subsidiary. Like in this case, when taking the asset and liabilities of 𝗓𝐸, you multiply that with 80%. That's a big mistake you can do. So the same case, when taking the asset and liabilities, or when preparing this consolidated statement of financial position, we prepare it as at the end of the year. Even if the subsidiary is acquired few months to the end of the year, like 1 month, 2 months, 3 months to the end of the year, never multiply the asset and liabilities of the subsidiary with or never apportion or basically multiply the asset and liabilities with a proportion of time, like what you're doing to the items of the income statement. I hope you can see what you're doing. We have done here. When taking the revenue and expenses of 𝗓𝐸, we have multiplied that with 9/12. These do not apply to the items of asset and liabilities, because this one we prepared it as at the end of the year. We want to show the asset and liabilities of the group as at the end. So never do this. Never multiply asset and liabilities of the subsidiary with the parent company shareholding in the subsidiary. Never multiply the asset and liabilities of the subsidiary with the proportion of time whereby the subsidiary has been acquired during the current year. That is one of the big mistakes which I've seen majority of the students doing in the past. So you take the full amount. So PP, we leave the bracket open, and then to this we have investment. So investment, you can see these are the investment purely by the parent, but you should take investment by the parent plus those of the subsidiary. But mostly this investment by the parent, this 116, this is the amount the parent company invested in the subsidiary, and also 𝗏𝗏. Basically that amount, we should not include it here. I'll be able to explain more on that. And then we will definitely compute the goodwill on acquisition of the subsidiary, and any goodwill on acquisition of the subsidiary, we recognize it here as an asset. So we are going to compute that. And then from there, we will record the current assets. So under the current asset, we have various items there. Inventory. We add that of the parent plus that of the subsidiary. I hope you can see we are not... okay, there is something I've forgotten to include here. There is something we are going to compute known as investment in associate. Our associate is 𝗏𝗏. Is 𝗏𝗏 Limited. That is actually the only item we include in the consolidated SOFP, consolidated statement of financial position, as far as the associate is concerned. Sasa, yes, but that one has to be computed. Let's come back here. we take the inventory of the parent plus that of the subsidiary, leave the bracket open, and then the trade receivables the same. Trade receivables the same. Those of the parent, 640, plus those of the parent plus those of the subsidiary. Below that, we have financial assets at fair value through profit and loss. That is the short form for that. Financial assets at fair value through profit and loss. We have 300 plus 150. And then below that, we have cash and bank balance. We do the same. We have 360 plus 200. So equally, leave the bracket open. And then after adding all the items here, we get the total assets. So then from there, we proceed and record equity. So for equity, we start with the ordinary share capital. Ordinary share capital. So for the ordinary share capital here, we only include the ordinary share capital of the parent company. Because I hope you can remember, we have said in preparing this, we only combine similar items of asset and liabilities. There is nowhere we have mentioned items of equity. So therefore, for share capital, we only include that of the parent company. The share capital of the parent is how much? Is 25. Is 25. Is 25. And I think in that case, we can go ahead and we do what? We can go ahead and basically do what? Include now the final figure. So the only time this particular share capital of the parent company will be having some adjustment is whereby the parent company acquired a subsidiary and basically paid the purchase consideration through something called a share exchange. I hope you know we do have different types of purchase consideration. The parent company, after acquiring majority of the shares in the subsidiary, the parent company can pay for that in cash. We have something called the cash consideration. We have something called the share exchange consideration. And also we have something else known as what? The deferred consideration. So the only time this share capital of the parent company will be having some adjustment is whereby the parent company paid the purchase consideration by issuing its own what? Shares. So we will check for that. But I don't think in this question, as per the information given in note 1, the share exchange or the parent company paid the purchase consideration through share exchange. So mean that this one we can record the final figure. Then below that, what do we have? We have share premium. Equally for share premium, this one we only include that of the parent. That of the parent is 500. So we just record it there. And then below that, we have a retained profit, or in other terms, the retained earnings. Actually, this is one of the items in an exam setup. Once you come across a question for group account, never bother yourself computing this, because if you check how we compute the group retained earnings, this one is a little bit demanding. So this is one of the items we usually advise the student in an exam setup, never bother yourself computing that. Sasa, if you can compute this figure and you get it correctly, it means that you have been able to adjust all the other items and you have gotten them what? Correct. And what we have said is that whenever you're tackling this question, whenever you come across such a question, you don't have to get everything correct for you to get all the allocated marks. Any correct entry you have here, you get 2 marks. Meaning that in that question, you just need to get 6 items here correct. So you don't have to get everything to be correct for you to get 12 marks. You just need how many correct entries? 6 correct figures. You get 2 marks for each, you get 12 marks. Just like what I've said here. You need to get 4 items correct. For each correct figure, you get 2 marks. You get the 8 allocated word marks. That's why I'm saying some items you don't have to compute them here, like this one. And then in that case, you get the total equity, which you don't have even to add. And then down here, there is also something which must be computed and recognized as an item of equity, known as non-controlling interest. Equally, is an item which you don't have to do what? To compute. Sasa? Yes. And then from there, we record the liabilities. We record the liabilities. The liabilities. For the liabilities, we start with the non-current liabilities. Non-current liabilities. So for the non-current liabilities, what do we have? We have the 12% loan notes. So these are items of liabilities. So any item of, or the items of liabilities, just like what you have done with the items of asset, we combine, we add those of the parent and those of the subsidiary. So we have 640 plus 480. Mostly these do not have adjustment, these items of non-current liabilities. Then below that, we have deferred tax. So for deferred tax, this one we add that of the parent 260 plus that of the subsidiary. And actually, there is something I've mentioned here. These items of tax do not have any adjustment. And equally, in the statement of financial position, if you come across an item of tax, like deferred tax, like current tax, also those are free marks. No single question for group account, deferred tax will have an adjustment. This one may have an adjustment. I will explain which adjustment when completing this, but this one do not have any adjustment. Get the final figure there. Any item of tax, be it the income tax in the income statement, be it the deferred tax, be it the current tax, no adjustment. Then we have the trade payables. Trade payables, we add that of the parent for 20 plus the 30, leave the bracket open. Then below that, we have current tax. This is another item of tax which do not have any adjustment. All items of tax do not have any adjustment. We get the final figure there. Final figure. And then finally, we will come and we get the total equity and liabilities, total equity and liabilities. Now that question, for example, if you do it like, assuming you do it in an exam setup and you leave it like that, even without going to the additional information, how many marks do you have here? How many marks do you have? You have 2 items there. Those are 2 items and 2 items here. So for any correct figure you have said you have it here, how many marks? 2 marks for each. So meaning we have said that in that question you need 6 correct entries or 6 correct figures. For each you get 2, you get 12. In our case, can you see how many entries, correct entries we have? 4. So it means that if that question you just decide to leave it like that, you have not even gone to the additional information, you have how many marks with you? You have 8. Here we said you have how many? 6. So if you can be able to understand how to approach this question, or basically how to do the general consolidation, then the question for consolidation are very simple. You can see this question, we have not even gone to the notes, and we have 6 marks there. We have 8 marks here. We have already 14 marks. There is nothing we have done. And that question, you can do it like that within even 15 minutes. You are done with that, provided you can remember this here. When preparing the consolidated income statement, income tax, distribution cost, these are free marks. Anytime you come here in the consolidated statement of financial position, and specifically at the non-current liabilities here, you come across an item of tax. Also, those are free marks. And mostly, this ordinary share capital is a free mark, except a case whereby the parent company paid the purchase consideration through share what? Exchange. Sasa? Yes. And I think now having that, what we need to do is we go through the additional information, and then we do what? We see which adjustments are required. So let's go to note number 1. And now the other thing, as far as the additional information is concerned, associate has not appeared much here. I think that's what you have said, Maureen. Maureen, what have you said regarding the associate? Do we include, for example, here, do we include the asset and liabilities of the associate here? I've said no. Do we include the revenue and expenses of the associate here? I've said no. That is what you have to remember. And I think that's what we said in the introduction part. So let's go to the additional information. In the additional information, number 1, you're told on 1st July 2022. 1st July 2022, it is basically this date, the date our subsidiary company was acquired. On 1st July 2022, 𝗙𝗏 Limited acquired 80% of the ordinary shareholding in 𝐶𝐈 on a cash consideration of 1,100 million. So this is the cash consideration paid by 𝗙𝗏 in acquiring shares of 𝐶𝐈. So this particular 1,100 is always accounted for by the parent company as an investment. And therefore, this investment by the parent, you see this one, this includes that amount of 11. So that amount, we don't include it in the consolidated statement of financial position, because that amount, we use it in computing this goodwill. So be less that 11 from that figure of 16, investment by the parent. And then what we will do is we are going to use that 1100 in the computation of that word, goodwill. Let's move to the other sentence of note number 1. We are told the fair value of assets and liabilities of 𝐶𝑖 were equal to their carrying amount at the date of acquisition. So this company, on the date it was acquired, it revalued the asset, and that ordinarily that is a practice that once the parent company has acquired the subsidiary company usually revalue the asset, and that process we refer to it as the fair value adjustment or the fair value exercise. And usually you'll be told in most of the questions that the subsidiary company had not accounted for that revaluation of what? Of assets. So what you need to remember is how do we, or which adjustment are required as far as that is concerned. What you do always, number 1, is you determine, was there a revaluation gain? That revaluation gain which was not accounted for by the subsidiary company, you add it to the group PP here, to the group PP. And number 2, when computing the goodwill on acquisition of the subsidiary, you also treat it as a pre-acquisition revaluation reserve. And then also you have to compute depreciation at the charge, but we don't have that revaluation gain. So number 2, we are told the group policy is to measure the non-controlling interest at their proportionate share of the net assets at the date of acquisition. I'll be able to explain more on that when looking on the computation of goodwill, because that information is to help you to know which method to use in computing what? The goodwill. Number 3, we are told on 1st January 2023, River Limited acquired 40% ordinary shareholding in 𝗂𝗂 at a cash consideration of 500. So when the parent company acquired 40% shareholding in 𝗂𝗂, the parent company paid how much? 500. That 500 is also included in this investment by the parent, and that we don't include it here. This 500, we use it in computing this, so you can't include it here again because you're going to use it in this. And that's why you can see once you take this minus that is actually giving us 0. That investment by the parent, it is what the parent has invested in subsidiary, in associate. That investment, you don't include it here. 1100, this one we're going to use it in computing this goodwill. This 500, we are going to use it in computing that what? Figure. So, and then number 4, we are told during the post-acquisition period, River Limited, which is now the parent, sold goods to 𝐶𝑖 Limited for 300 million. So that is sales between the parent and the subsidiary. The parent sold some goods which had a value of 300 million to the subsidiary. So it is obvious that this company here accounted for that as sales. The parent company accounted for that as sales, whereas this one accounted for that as purchases. Purchases is always included in the cost of sales. But now, any sales between the parent and the subsidiary, that one should not be included in the consolidated income statement. So any sales between the parent and the subsidiary, we eliminate that from the revenue, and also we eliminate that from the cost of sales. This company accounted for that as revenue. This company accounted for that as purchases. But I've said purchases is part of the cost of sales. That's why we are saying we deduct this from the revenue here, because that one should not be accounted for as the revenue from the group perspective. And then this one we deducted from the cost of sales because it was included in the cost of sales of the subsidiary. That is very important. Any sales between the parent, eliminate that from the group sales, eliminate that from the group cost of sales. And actually, that is the only adjustment which affects the group revenue. So meaning that for the group revenue, you can cross the bracket. The only adjustment which affects this or which is made to this is any sales between the parent and the subsidiary. So, yes, can we cross the bracket there and we get the final figure? We get the final figure because I've said that is the only item which affects this. So the sales between the parent and the subsidiary, which we refer to as the intra-group sales. Intra-group sales or intra-group what? Trading. So give me the final figure there for group revenue. Group revenue will be how much there? How much are you getting as the final figure? Yes, so that will give us 5840. 5840, 5840. Okay, so we are done with that. And then in the other sentence of note number 4, we are told 𝗓𝗏 Limited reported a gross profit margin on these goods, and then you are told half of these goods remained in the ending inventory of 𝐶𝐈 Limited at the end of the year. So I hope also you have gone through this particular topic, and actually you know some of the consolidation adjustment, so which you need to do. So anytime you're told the parent company sold some goods now to the subsidiary, it is obvious that the company which sold the goods, which is the parent, made a profit. And that profit, we say it is realized if all the goods which were sold to this company here would have been sold to third parties at the end of the year. But if some of the goods will not have been sold to third parties, some of the goods remained in the inventory, in the closing inventory of this company, then the profit reported on those goods will not be realized. And therefore, if you come across that information that some of the goods sold to this by the parent were not yet sold, you compute something called the unreleased profit. How do you compute this? You take the goods which are not being sold, the unsold goods, you multiply that with the gross profit margin. So in our case, we are told that the goods which were not yet sold, as per note number 4, the last sentence, were half. Half of the goods remained unsold. Half of the goods which were sold by 𝗓𝗏 to 𝐶𝐈. The goods which were sold by 𝗓𝗏 to 𝐶𝐈, they had a value of 300 million. So these are the unsold goods, half. Half of those goods, half. And then you multiply that with the gross profit margin. The gross profit margin in our case is, we are given that in note number 4, the second sentence, 20%. 20% of this. This is the unreleased profit. So how much is the unreleased profit? 150. 20% of 150 is 30. Is 30. So the unreleased profit here is what? Is 30. Is that, are you getting 30? Are you getting 30? Are you getting 30? Yes, 30. So how do we, which items are adjusted with this unreleased profit? The unreleased profit, number 1, is always deducted from the group inventory. We deduct it from the group inventory, and number 2, we add it to the group cost of sales. Those are the 2 key adjustments. Raise it from the group inventory, add it to the group cost of sales. Add it to the group cost of sales. Those are the key consolidation adjustments. So, sir? Yes. So let's move to the other point. We are done with that point number 4. Let's move to point number 3, to point number 5, sorry, to point number 5. In point number 5, we are told included in the trade receivables of 𝗓𝗏, which is now the parent, included in the trade receivables of the parent 𝗓𝗏 was shillings 80 million due from S, or due from 𝐶𝐈 Limited. And then you're told in the books of 𝐶𝐈, the amount due from 𝗓𝗏 was 60 million because 𝐶𝐈 Limited had remitted shillings 20 million, but 𝗓𝗏 Limited had not recorded the remittance. So that one, we refer to it as the amount of intragroup trading. Not intragroup trading, sorry, amount of intercompany debt. Amount of intercompany debt. And actually, in this case, the amount of intercompany debt is not the same. So we are told the receivables of this, the receivables of the parent included 80, the amount which was due from 𝐶𝐈. Now that 80, we come and we deduct it from the group receivables, because any amount of intercompany debt, any amount of debt between the parent and the subsidiary should be eliminated from the group receivables and group payables. So the receivables of the parent include 80, the amount it is expecting to receive from the subsidiary, less that from the receivables of the parent here. And then we are told in the other sentence, the payables, the trade payables of the other company, which is 𝐶𝐈, included 60. 60 is included in the payables of the payables of 𝐶𝐈. So deduct that here. Deduct that there. And we are told the difference of shillings 20 million is due to a remittance which was made which was made by 𝐶𝐈 but had not yet been received by 𝗪. So this 20 million, for those who have gone through this particular topic, what is the name given to that? The 20 million, the amount remitted by 𝐶𝐈 but not yet received by 𝗪. So for those who have gone through this topic, which name is given to that amount there? Yes, I'm told by Gaspard, by Caroline, by Clement, that is cash in transit. Very correct. That cash in transit, we added to the cash and bank balance. That one we added here. Cash and bank what? Balance. We refer to that as cash in transit. Cash in transit, we added there. I've said from receivables less 80, from payables less 60, to the group cash and bank balance, we add the cash in transit of what? Of 20. So we are done with that. Let's move to point number 6. And we are told on 1st of October 2022, this is some few months at the end of the year, we are told that River Limited, which is the parent, sold an 𝗙𝗵𝘁 plant. An 𝗙𝗵𝘁 plant is basically an asset. The parent company sold an asset to 𝐶𝐈, which is a subsidiary for shillings 400 million, reporting a 25% profit margin on the selling price, and netted off the profit against its cost of sales. So basically, this sale of assets. This is not sale of goods. This is sale of assets. I'll explain the adjustment for this. And then you're told the group charges depreciation on plant at the rate of 20% per annum on cost on full year basis in the year of asset purchase and none in the year of disposal. So basically, how do we deal with that adjust or such a transaction where we have the parent company selling an asset to this? So what you need to do as far as such transaction is concerned is that you compute the unreleased profit. You compute how much profit was reported by the selling company. So that profit which was reported by the selling company, the entire profit will not be realized simply because whenever the parent sell an asset to the subsidiary intend to use that asset. The asset will not be sold to third parties like goods. So therefore, the profit which was reported by the selling company, the entire profit will not be realized. And actually, the effect of that unrealized profit is that it overstates the PP of the buying company. The PP of this will be overstated with an unrealized profit, and also that means that this company will be basically overcharged depreciation because its PP were overstated. But even before we deal with that, how do we compute this unrealized profit? You take the selling price of the asset times the gross profit margin. So the asset was sold at how much? The asset was sold at 400 million, and then you're told the gross profit margin or the profit reported was 25% profit margin. So this is a quarter. This is a quarter. This is a quarter. So this will give us what? A quarter of this. Is it 100 million? Is it 100 million? Yes or no? Yes, it is 100 million. So this 100 million, we come and we erase it from the group PP because we are saying the PP of the buying company, the property, plant, and equipment of this company will be overstated with this because this company will account for those goods at selling price. So its PP will be overstated with this. So less that from the group PP. And then we also need to compute now the depreciation other charge. If the PP of the company are overstated, the PP of the subsidiary are overstated, that company will be overcharging depreciation. So how do we compute this depreciation overcharge? We take the this unrealized profit, this one, because we compute this one based on the unreleased profit, 100 million. And what are we told, or how is this company depreciating plant? We are told the group charges depreciation at the rate of 20% per annum, and a full year on a full year basis. So to compute depreciation overcharge, we take 20% of this, and despite the asset having been sold in course of the year, we are told that the policy of the group is to charge a full year depreciation. A full year what? Depreciation. So therefore, despite the asset having been sold some few months at the end of the year, we are going to provide a full year depreciation. So this will give us 20 million. 20 million, 20 million. So how do we deal with this depreciation overcharge? This, remember, is depreciation overcharge, or C for overcharge. So this depreciation overcharge, number one, we add it to the group PPE. We add it there because if a company is overcharging depreciation, then the net book value of its PPE will be understated. That's why we add it to the group PPE. Number two is that we know depreciation for the current year. This is something we know from the topic of published. The depreciation is always included in the cost of sales. So mean that this company overcharged depreciation with 20. So the depreciation included in the cost of sales of the subsidiary is more with 20. So less that from the group cost of sales. Less that from the group cost of sales simply because the depreciation included in the cost of sales of the subsidiary was more with 20. So those are the adjustments which we make as far as the sale of asset by the parent and the subsidiary is concerned. Compute the unreleased profit, deduct that from the PPE. Number two, compute depreciation overcharge, which you add to the group property, plant, and equipment, and you less it from the group cost of sales. We are done with that. And then let's move to point number 7. In point number 7, you're told impairment test carried out on 31st of March 2023 revealed that neither the goodwill on acquisition nor the investment in associate had been impaired. So basically, the goodwill on acquisition had not impaired. There is something you have to recall very fast. We say that any impairment loss on goodwill for the current year, that impairment loss is added to the administrative expense. And actually, that is the only item which we add here. So we are told there was no any impairment loss on goodwill. So meaning that in that case, we can in fact get the final figure for this one. So this one will be 300 plus this, which will give us what? 800, because we don't have any impairment loss. Then finally, we are told none of the group company had paid dividends. So the reason why you're given that information is because once this company paid dividends, some of those dividends are paid to the parent company. So whenever the subsidiary company or even the associate pay dividends, like 80% of these dividends will be paid to the parent. 40% of the dividends paid by this will be paid to the parent, and the parent company go ahead and recognize that or account for that for the dividends received from associate and subsidiary as an investment income. So, and that investment income or those dividends received by the parent from the associate and subsidiary, which will have been accounted for by the parent company as an investment income, that one we don't include it in our consolidated income statement. What we include in the consolidated income statement is any investment income received by the parent company, but outside the group. So the reason why you're given that information is for you to know that this investment income by the parent is an investment income generated or received outside the group. Which should be included here. Equally, it means that for this one, we can get the final figure. But if the parent company had received dividends from the subsidiary or associate, and the parent company had already accounted for that as an investment income, you should come and you less the dividends received from the associate here, the dividends received from what? The subsidiary, because it's an investment income from within the group. But in our case, we don't have that. So mean that we can get the final figure here. So this will be 15 plus 40. That will give us 55. So, and I think that question we are done. We are almost done, because I think what is remaining here is for us to compute 2 items. And basically, I have to show you how to compute these 2 items, goodwill and investment in associate. Because if you check on most of the questions from these past papers, usually you'll see they require the computation of goodwill, and you allocated separate marks for that. And also you compute investment in associate, you allocated separate marks for that. But we are almost done because the other items do not have any adjustment. For example, you're done with the cost of sales here. We are done now with all these items there. We are done with the finance cost. This one will not have any adjustments, including most of the items of assets and liabilities. We are done with the PPE. So what is remaining is computation of these 2 items. I need to show you how to deal with those 2 items. And then all these items, we are done with them. They do not have any adjustments. We just cross the bracket now. We just cross the bracket here. all these items do not have any what adjustment. So let's get the final figure, and then I want to show you how to compute these two items. So let's get the final figures here, starting with the income statement. We start with the income statement. We have the final figure for this. Let's get the final figure for revenue. And I want us to move together. So let's get the final figure for revenue here. So this will be what? 1400 times 9 all over 12, which will give us 1020 plus 14 minus 300 plus minus 20 plus 30 plus 30. So I'm getting 2160 here. Is that what you're getting? Cost of sales, are you getting 2160? Okay, so Clement is confirming that. So we already have this as the final figures. So let's get the final figure for what? For the finance cost. For the finance cost, this will be 3/4 45 plus this, which will give us 125. So, okay, someone is saying I use a different color. I don't have a different board marker. So I only have a black one, but maybe in your case, you can just use a different color for the final figures. Or you're asking a question, can you use the... Yeah, okay. So just get on your side, use a different color. I don't have a different board marker. Someone is saying Zainab, I'm getting that 34, 90. Which figure for are you getting? Yes, if you're getting a different answer, just give yes, because my answer may be wrong. That's why I need confirmation. You need confirmation. So this figure is wrong, eh? Yes, that's why I need to get confirmation from you. I need to get confirmation. I'm told it's 3490. Yes, it may be 3490. That one I agree. Yes. Okay. So let's get then the correct gross profit. Gross profit therefore should be what? 2350. Yeah. Okay. So then I think the other figure which I've computed here is the finance cost. I've said this will be 3, 4, 15. 15, is it 15 or 12? Yes, 45 plus this, which will give us 125. That is okay. Yes, so let's get now this profit from operation. Profit from operation would be our gross profit, which is 2350 plus this one profit, the parent company share of profit in associate, plus 20 minus 450 minus 800. So I'll get 1120. 1120. Then I add the investment income. Investment income should be added. Then I less the finance cost. I'll get 1050. Then I less tax. I'll get 750. I'll get 750 like that. Okay. So then let's move to the statement of financial position so that we record, first of all, the final figures. Okay. And then I can see our time is running out because there are 2 items I needed to show you there. Though no worries, that is something we can be able to do in our next session. So let's get the final figures. These two items, I'll show you how to compute them in our next class, because I can see we have just like 20 minutes and I have another class from 6. So let's get the final figures for PP 2070 plus 1290 minus 100 plus 20. So I'm getting 3280. So let's move together so that you confirm for me whether the figures I'm getting are correct. So then I've said for these two items, goodwill and investment in associates, these I will show you how to compute them in our next session. As we look another question for group account. So let's go to the inventory. So 530 plus 390 minus 30. Okay, Mwalimu is getting everything wrong today. I'm told that is 3240 because it's 2070. Yes, someone to confirm the figure for PP. That is the same figure, the one I'm given by there, 3240. $32.40. I'm getting 3280. It should be 3280. Okay, so let's come to the inventory here. Inventory have 530 plus 390 minus 30, which will give us 890. What about receivables? We have 640 plus 470 minus 80, 1030. This one will be 450. What about the cash and cash equivalent? This will be 560, 580, 580. You don't even have to get the total here because these are the items which are marked. These are the items which are marked, not the total. So I think we have the final figures here. What we need to get are the final figures for liabilities. So these will be 1120. The trade payables we have for 20 plus 330 minus 60. Minus 60. So we get what? 690. We get 690. So equally, I'm saying no need of getting this. So in such a question, what I've said is that for you to get the 12 allocated marks, then I've said you just needed 6 correct entries. 6 correct what? Entries. Any 6 entries for every correct entry which you get. How many marks? 2 marks, 2 marks. So basically that question, even without computing so many items here, we already have all the marks. We already have all the marks because you can see we have more than what? More than 6 entries. But what I've said is that in our next session, because I can see our time here is over. Our time is over. So I think there is, I've said there are those items you don't need to compute. You don't have to compute group retained earnings. You don't have to compute this. Never bother yourself computing those 2 items. Never bother yourself computing those 2 what? Items. If you can compute those 2 items, you get them correct. It basically means that you have been able to adjust all the other items and you have them what? Correct. So I've said in such a question, you don't have to get everything correct. Just need to get 6 correct entries. Each entry, how many marks? 2. That's how basically you pass in this question for group account. It's not about perfection. It's basically by knowing how do you get the marks. It's not about balancing. It's not about ensuring total assets are equal to total equity and liabilities. Basically knowing where do you get free marks. Sasa? Yes, because we are saying this question is a little bit demanding. You have to do it. Also, the time for you to do this question is not more than 40 minutes. And you have now to get the marks there. Sasa? Yes, that question I've said, if you do it like that, you'll have gotten all the marks, even without computing so many what? Items. But once we meet in our next session, definitely I'll show you how to compute these 2 items here as we look another question for what? For group accounts. And because I can see our time is over, we have how many minutes? We have a few minutes here. I want us to stop at that point, and I hope you're still